Imagine a world where the money in your wallet isn't truly yours, where the value of your savings, your salary, even your future is quietly dictated by an invisible system that most people never question. Every government, every bank, and nearly every economy on Earth operates under rules written by a handful of powerful institutions, central banks. And here's the shocking part: while the public debates taxes, inflation, and interest rates, central banks are pulling levers that shape global wealth on a scale that would make most people dizzy. How is it possible that a tiny number of institutions quietly controls trillions of dollars without anyone noticing? By the end of this video, you'll see the hidden threads connecting centuries of financial decisions and why the system may be far more fragile than we dare imagine. To understand how central banks hold this power, we have to go back in time. The idea of a central bank isn't new. The first modern central bank, the Sveriges Riksbank, was founded in Sweden in 1668. But it wasn't just a bank, it was a blueprint for how governments could manipulate money without overtly raising taxes or seizing wealth. Key figures like Alexander Hamilton in the United States and Rothschild banking families in Europe shaped early banking structures. They understood a simple truth: control the issuance of money, and you control economies. At first, this was subtle loans to governments, regulating interest rates, but over centuries, the system grew into a quiet, almost invisible web that links every major economy. Here's the twist few people realize: the system that was meant to stabilize economies often serves to enrich a select few while keeping the masses dependent on debt. The concept of central banking began with debt as a tool. Governments needed money to wage wars, build infrastructure, and fund public services. Instead of raising taxes, which was politically dangerous, they borrowed from private banks, promising repayment with interest. Over time, central banks became intermediaries, creating a monopoly on currency issuance. For example, the Bank of England, established in 1694, lent money to the government to fight wars while also issuing banknotes that became the backbone of Britain's economy. The mechanism was simple but profound: create the money, set the interest rates, and quietly influence who gets rich and who stays in debt. By the 20th century, this model had spread globally. Central banks were no longer just lenders. They were architects of entire financial systems, wielding the power to expand or contract money supply, influence inflation, and determine which industries thrive. The real consolidation of power came after the Great Depression. Economies were collapsing, and governments needed a solution. Enter the Federal Reserve, established in 1913. Its mission: to stabilize the American economy, but in practice, it became a mechanism for controlling credit, debt, and wealth distribution. Central banks perfected the art of quantitative easing, open market operations, and interest rate manipulation. On the surface, these tools appear technical and harmless, but in reality, they allow banks to inflate asset prices, making the wealthy wealthier, while the average worker sees only stagnating wages. The rise of global trade and international finance only increased this power. By controlling exchange rates and debt issuance, central banks could shape economies thousands of miles away, often without any direct intervention. But control has its limits. Crises expose the system. The 2008 financial meltdown is a prime example. Banks had leveraged trillions in risky bets, governments were on the brink of collapse, and central banks stepped in, printing unprecedented amounts of money to prevent total economic collapse. Here's the paradox: their intervention saved the system, but it also deepened inequality. Stock markets recovered quickly, but wages lagged. Ordinary citizens bore the burden through austerity measures and inflation, while banks and institutional investors reaped massive gains. It's a repeating pattern. Every economic shock becomes a windfall for the few, a hardship for the many, all orchestrated under the guise of stabilization. The fallout is subtle but persistent. By quietly controlling interest rates, central banks can manipulate debt cycles. Countries like Greece, Venezuela, and Argentina show what happens when debt spirals out of control, yet the mechanisms are the same in every developed economy. They just operate on a less visible scale. Modern wealth concentration is staggering. According to recent data, the top 1% control nearly half of global assets, while trillions of dollars are effectively created by central banks through digital interventions, bailouts, and asset purchases. The public sees only partial effects: slightly higher rents, inflation, or interest rate changes, while the core levers of control remain invisible. Attempts to fix this system are rare and often fail. Currency reforms, debt jubilees, or stricter banking regulations often backfire because central banks and governments are intertwined. Removing the power from these institutions is not just a financial challenge, it's a political impossibility. Every proposed reform has one unintended consequence, either creating new bubbles, deepening inequality, or both. The invisible hand is not just market-driven, it's centrally orchestrated. Fast forward to today, central banks continue to expand their influence through digital currencies, low interest rates, and massive bond purchases. The COVID-19 pandemic saw trillions injected into economies worldwide. Stock markets soared, corporate debt exploded, and yet average households struggled with inflation and stagnant wages. Here's the chilling realization. Every major crisis, from 1929 to 2008 to 2020, follows the same pattern. Central banks rescue the system, consolidate power, and maintain the illusion of stability, all while ordinary citizens unknowingly carry the burden of debt. Data shows this is not accidental. In 2023, global debt exceeded $300 trillion, yet the invisible machinery of central banking ensures the wealthy continue to profit, reinforcing centuries-old patterns. Debt is a tool of control, not just finance. Every loan, bond, and interest rate is a thread in a larger web designed to influence economies quietly. Central banks profit from crises. Every major financial shock strengthens the institutions meant to stabilize the system, consolidating wealth at the top. Wealth concentration is systemic, not accidental. Modern inequality is not merely a social issue, it is engineered by mechanisms most people never see. If you think this is just history or theory, think again. The invisible control continues today through digital currencies, AI-driven trading, and global debt instruments. Understanding it isn't just curiosity, it's survival. The question isn't whether central banks control global wealth, it's how long the system can maintain the illusion of fairness before it reaches its breaking point. If this video opened your eyes to the hidden forces shaping our world, hit like and subscribe. Turn on notifications because we lines be diving even deeper into the financial secrets governments don't want you to know. Knowledge is power, and the first step is seeing the system for what it really is.